Welcome to our lecture series in financial management. Today we will review the preferred stocks. Let's begin. Preferred stock is a hybrid security combining characteristics of both common stock and bonds. It represents an ownership claim in a corporation, offering priority over common shareholders regarding dividends and liquidation. These stocks generally provide fixed dividends and have limited or no voting rights, making them attractive for income-focused investors. In corporate finance, preferred stock helps firms raise capital without diluting control or incurring legal debt obligations. Key characteristics differentiate preferred stockholders from common stockholders, starting with fixed dividend payments, typically expressed as a percentage of par value. Preferred shareholders also have priority over common shares, meaning dividends must be paid to them first. However, preferred shareholders usually do not have voting power in corporate elections, unlike common stockholders. Preferred shares exhibit a hybrid nature, behaving like equity in ownership but providing income similar to debt. Many preferred shares include callable provisions, allowing the firm to buy them back at a set price, and some offer convertible options into common shares. For example, a preferred share with a $100 par value and a 6% dividend rate yields an annual dividend of $6. If the market price is $90, the current yield is calculated as $6 divided by $90, resulting in 6.67%. Preferred stock comes in various forms, each offering different rights and conditions. Cumulative preferred stock means missed dividends accumulate and must be paid before common shareholders receive any. For instance, if a company misses 3 years of $5 preferred dividends, it must pay $15 before common shareholders get any dividends. Non-cumulative preferred stock conversely means missed dividends do not accumulate. Participating preferred stockholders may receive additional dividends if the company performs well, while convertible preferred holders can convert shares into a fixed number of common shares. Callable preferred stock allows the company to redeem shares at a predetermined call price, typically $102 to $105 per $100 par value. Adjustable rate preferred stock features dividends that vary with market interest rates, often tied to benchmarks like LIBOR. Preferred stock is primarily used by banks, utilities, telecommunications firms, and insurance companies. Companies use preferred stock to avoid interest expense on debt, protect their credit rating, and prevent dilution of voting control. Valuation of preferred stock treats it as a perpetuity since dividends are fixed, using the formula P equals D over R. For example, if a preferred share pays a $7 dividend and investors require an 8% return, the price is $87.50. However, if required returns rise to 10%, the price drops to $70, demonstrating preferred stock's interest rate sensitivity. Both common and preferred stocks represent ownership, but common stockholders have full voting rights, which preferred stockholders typically do not. Common stock offers uncertain dividends and price appreciation, while preferred stock provides fixed dividends and limited price appreciation. Common stock is riskier due to unguaranteed dividends, whereas preferred stock is less risky because dividends are predetermined. In liquidation, creditors have the highest priority, followed by preferred shareholders and then common shareholders. Typical investor preferences show common stock investors seeking growth, while preferred stock investors prioritize income and stability. Preferred stock shares similarities with bonds, both promising fixed periodic payments and sensitivity to interest rate changes, and both having priority above common stock. However, key differences exist. Bond interest is a legal obligation, while preferred dividends are not. Bonds have a maturity date, but preferred stock is usually perpetual. Bond interest is tax deductible for the issuing firm, unlike preferred dividends. Bonds are safer with lower yields, while preferred stock is riskier with higher yields. Bondholders have no ownership or voting rights, whereas preferred shareholders have ownership, though often without voting power. For companies, advantages include no legal dividend obligation and no voting dilution, but disadvantages are higher costs than debt and non-tax deductible dividends. For investors, preferred stock offers higher yields than bonds and priority over common stock, but comes with limited upside potential, callable risk, and interest rate sensitivity. In summary, preferred stock is a hybrid security blending debt and equity features, appealing to income-seeking investors and offering companies flexible financing without diluting control. Thank you for joining us for this lecture on preferred stocks. See you at the next lecture.